All right, let's break down Standard Chartered's first half 2025 earnings call. Now, on the surface, they posted a huge beat against what analysts were expecting. But the real story here is how they pulled it off and what that tells us about where they're headed. So, this is your quick analyst briefing. Let's get into it. So, here's how we're going to tackle this. First, we'll hit those headline numbers and that big beat. Then, we're going to look under the hood to see what really drove the results. Third, we'll unpack what management is planning for the future. Fourth, and this is a big one, we'll dive into their major bet on digital assets. And finally, we'll put it all together for our final rating. Let's do this. Okay, first up, the headline beat. Whenever a bank reports, the first thing everyone looks at is simple. Did they beat or miss the consensus? Well, in this case, Standard Chartered didn't just squeak by. They blew right past expectations. And I want to be really clear here. This was a decisive beat. In a tricky environment where investors are picking apart every single number, coming in this strong sends a really powerful signal about how well they're operating. So how big was it? We're talking over $500 million. To be exact, their profit before tax, or PBT, came in $550 million higher than the analyst consensus. For a bank this size, believe me, that is not a rounding error. That's a huge statement. And this slide really puts that scale into perspective. You can see the reported PBT right there, $4.38 billion versus the $3.83 billion everyone was expecting. But check out the earnings per share, their EPS, at over 129 cents. That's a 55% jump from last year. This wasn't just about beating a number. It was about showing some serious earnings power. So what do you do when you're performing this well and feeling this confident? You give cash back to your shareholders, and you do it aggressively. Management immediately rolled out a new $1.3 billion share buyback and jacked up the dividend by a massive 37%. That tells you they really believe in their own ability to generate cash. But look, that big profit beat is just the headline. To really understand what's going on with this company, we have to dig a little deeper. And when we do, what we find is really a tale of two completely different income stories. And this right here is the absolute crucial point. On the left, you have net interest income. That's the money they make on loans. It was basically flat. Why? Because it was getting squeezed by lower interest rates, especially in Hong Kong. But then look to the right, non-interest income. That's all the revenue from fees and trading. It absolutely surged by an incredible 31%. This was the engine that powered the entire beat. So, where did that 31% pop come from? Well, it was pretty much across the board. The global markets business was up 28%, cashing in on market volatility. Their wealth business grew 24% thanks to a ton of new money coming in from wealthy clients. And even global banking was up a solid 14%. So this isn't a one-trick pony. All their fee-generating businesses were firing on all cylinders. Okay, so that's the story of what happened. Now let's pivot and talk about where they're going. We need to look at management's playbook, their guidance, their cost discipline, and their big transformation plan. Now, at the very heart of their strategy is this program called Fit for Growth. And management really hammered this point home. This is not just about cutting expenses. It's a much deeper plan to save about $1.5 billion by making the bank simpler, more digital, and way more efficient. It's really about building a better bank for the long haul. And this all translates into some pretty specific targets. For this year, 2025, they actually raised their full-year income growth forecast to a 5 to 7% range. That's a huge sign of confidence, even though they admit that the interest income part will be down a bit. Then, looking further out to 2026, they're sticking to their guns on keeping expenses under $12.3 billion and targeting a key profitability metric, their RTE, of around 13%. Okay, now for what I think is the most forward-looking and maybe the most exciting part of the Standard Chartered story, their huge strategic bet on digital assets. And I want to be clear, this is not some little side project for them. This is a core piece of their vision for the future. They talk about building a digital bridge for their big institutional clients, and they're doing it in very deliberate, logical steps. It started with laying the foundation, with things like Zodia for custody. Now they're moving into issuing stablecoins in Hong Kong, they're launching trading desks for Bitcoin and Ether, and they're even getting into tokenizing funds. It's a really comprehensive, thought-out strategy. And if you had any doubt at all about how committed they are, just listen to the CEO, Bill Winters. He said, We believe more strongly than we ever have that this is an inexorable direction of travel. That one word, inexorable, it says everything. To them, this isn't just some fad, it is the future, and they're planting their flag right in the middle of it. So, that brings us to the final section, the next call. We've gone through the big earnings beat, what drove it, the plan for the future, and their big crypto strategy. Now it's time to put it all together into a clear investment thesis and give it a rating. So it all boils down to this one question, right? We've seen the strong results, we've seen the strategy. After digging through all the data from this earnings call, what is our final take on the stock? The bull case, the argument for the stock, is really strong. It all starts with that powerhouse fee income engine that's proving it can handle the pressure from interest rates. Management is showing huge confidence with those buybacks and dividends, and all the while, they are building what could be a massive competitive advantage in digital assets. You add in good execution and cost control, and it's a very positive story. But of course, you always have to look at the other side of the coin. No investment is a sure thing. For the bears, that pressure on interest income isn't just going to vanish. There's also a real risk that loan losses, which are super low right now, start to creep back up. And their big footprint in China and Hong Kong brings some geopolitical risk. The biggest question of all is whether those amazing trading revenues can last or if they were just a one-off. So, after weighing the bull case against the bear case, our call is an outperform rating. Yes, the risks are real and you can't ignore them. But we believe the bank's fundamental strengths and its clear strategic vision more than outweigh those risks. So here is our thinking in a nutshell. The combination of that powerful, diversified fee growth with their incredibly smart first-mover strategy in digital assets creates a story that is just too compelling to ignore. In our view, this gives the stock a clear path to be valued higher by the market, and that's what justifies our outperform rating. And as always, please remember, this analysis is just for informational purposes. This is not financial advice.